been a whole year plus since I made my first video revealing all my stocks in my long-term dividend growth portfolio. And a few $1,000s later and some more testosterone in my body, we're in a much better spot right now. Hey guys, welcome to the first ever edition of the Ryan Dangler Show.
Excuse me, sir. I hope my horrible ugliness won't be a distraction to you.
Not at all, boy!
So in today's video, I'll be reanalyzing all 33 stocks in my long-term portfolio. I'll be giving my updated future outlook on them, their 5-year CAGRs, their dividend info, and much more. If you guys enjoy content about dividend growth investing and investing news, I post all videos on here regarding to that, portfolio updates, updates on stocks that have fallen recently, and much more. I'm trying to get to 150 subscribers by the end of the year, so it'd mean a lot. Now that you've done that, smash the like button, subscribe, turn on post notifications, and of course, roll the intro.
Hello, I like money.
The first stock in my portfolio is going to be Apple. Apple is probably one of my favorite companies in the world and one of the highest quality companies in the world in my opinion. They have a payout ratio of 14.29%, a great economic moat, a pretty small dividend, but still they have plenty of room to grow that with all the money they're bringing in. They perform consistent share buybacks, have 9 years of dividend growth, and have great increased free cash flow. Apple has the strongest brand in the world, which is why it's so intriguing for me to invest and have it as a core position in my long-term portfolio. Apple is currently trading at a P/E ratio of 22.91, which I think for Apple's growth prospects, economic moat, and all they have to offer with their company, I think that's definitely a fair value to buy Apple at. I give Apple an A+, and I think it's a buy right now. The next stock on the list is definitely my favorite company in the world, which is Microsoft. While Microsoft does have a micro dividend, that 5-year CAGR of 9.6% definitely shouldn't intrigue you away from investing. I could make a 5-hour video of saying everything I love about Microsoft, and which I might one day. But personally, what excites me most about Microsoft is their gaming business that they've been building up recently. They are becoming the Netflix of gaming with their Game Pass subscription service, which I am a consumer of. They have tremendous free cash flow and I think are a pretty recession-proof stock compared to the other technology businesses. People are saying that their Activision Blizzard deal won't go through, but I think this is silly considering that a lot of the gaming competitors from Microsoft are non-American companies. I had to give Microsoft an A+, and I think currently trading in a P/E ratio of 26.98 is definitely fair for all that their assets that they obtain. I think it's undervalued right now, and I would buy at current prices if I had a lot of money. The next stock I own is Visa, stock ticker V. They have a dividend yield of 0.75%, a nice payout ratio of 21.54%, and an amazing 5-year CAGR of 17.87%, which is amazing to see. Visa is recently a company that I've bought into recently, and I've done my research, and I've realized that I want it to be a core position in my portfolio for the next century. They are a perfect company fundamentally speaking on the balance sheet, and once again, that 5-year CAGR of 17.87% is just amazing. Currently, Visa is trading at a P/E ratio of 27.62, which I definitely, again, kind of with the Microsoft alignment, I think that's definitely a fair price for all the assets that they obtain and the wide economic moat that they obtain as well. I have Visa as an A+ right now as my score, and I think I have it as a hold, but personally for me, I'll be dollar cost averaging in and buying on dips. The next stock on my list is a giant in 3M. There's a saying that you're never 10 feet away from a 3M product, which I think speaks to how big their business is. My good friend Citizen of the Year made a video about 3M and why their stock has been down so much recently because of some of the lawsuits that they've been facing. I would definitely recommend you guys check that out before investing now, but I've realized that they're such a great business. They've had accusations and lawsuits that they've had to deal with before, just like every big and large company, and I think they'll get by it easily. 3M is trading at a P/E ratio of 13.73 and has 63 years of consecutive dividend growth. They pay a dividend of $5.96. So I think 3M is definitely, I know it has slow 5-year growth rate, but I think it's still a staple to have in your portfolio for that dividend income net. Right now, I have 3M at a buy as well. The next stock on my list is Starbucks. Starbucks has been falling a lot recently. They have a dividend yield of 2.72%, a payout ratio of 57.83%, a nice 5-year growth rate of 15.11%. They recently suspended their share buyback program because they want to invest it back in their spoiled employees. If you want to hear more about that, go watch the Starbucks video I made. They have a 25 PE ratio, which I think is fair for Starbucks' growth potential, 12 years of dividend growth, great increased cash flow, and I gave it an A- on my list, and I think it is a buy right now. Starbucks has great pricing power, a tremendous brand, and a great wide economic moat during this time. The next stock on my list is beloved by dividend investors, the healthcare company AbbVie. AbbVie is currently trading at a 10.82 PE ratio, which is really undervalued for how great of a company they are. This is because they are losing access to Humira, or their specific patent towards Humira, in 2023. They have an amazing 5-year CAGR of 17.5%, a nice payout ratio of 42%, and a juicy yield of 3.72%. They have increased cash flow for the last 10 years, and I gave it an A, and I think it is a buy right now. I'm currently not buying any, though, because I think there are better opportunities during this time. The next stock is a dividend king and PK Investing's favorite company, which is JNJ. JNJ, they have a really safe dividend, 42% payout ratio, 2.6% yield, a pretty slow CAGR of 5.79%, but you can't expect anything big from a company that huge and that's been around that long. They have gradual share buybacks. Their dividend amount is $4.52. Their PE ratio right now is 16.96, which I think is, I think there are better opportunities during this time for sure. It hasn't been declining compared to the other stocks right now. They have slow and steady free cash flow growth. I gave it an A- just because you aren't getting huge growth, but slow and steady wins the race in my opinion, and that's definitely what J&J offers. I gave it a hold right now because I think J&J is a great company, but I think it's not the best company to buy during a time like this where there's a lot of fear in the market. The next stock is McDonald's, stock ticker MCD. I made a McDonald's stock review last summer, and I might have to do an updated one soon. Similar to some of the companies that I mentioned earlier, McDonald's has one of the most powerful brands in the world and a wide economic moat. Their consistency around the world, and you know what you're getting when you go to a McDonald's, whether you like it or not. I think that's what separates it from most fast food and restaurant companies. McDonald's is currently trading at a 23.15 PE ratio, which I think for a restaurant company as big as McDonald's is a little high, so I will not be buying at this time. So I have as a hold. They have 13 years of consecutive dividend growth, great increased cash flow, a 5-year growth rate of 7.85%, which is good, payout ratio of 55%, which again is manageable, and a yield right now of 2.41%, which is on the lower side because of how high their stock price has gotten. They recently pulled out the restaurants of Russia along with Starbucks, which will be interesting to see how that plays out. I love McDonald's. I want it to be a top 10 stock in my portfolio, but right now I just don't think it is a great time to buy in. The next stock I own is one that I recently bought into, which is Intel, stock ticker INTC. Intel has a dividend yield right now of 3.5%, which has just gotten higher and higher with the stock price declining. A nice payout ratio of 28.43%. A 5-year CAGR of 6.25%, which they will be increasing, by the way. They have gradual share buybacks, and they have a 12 PE ratio right now, which in this market is very cheap. Right now, their free cash flow is flat, mainly because they are investing a lot of money right now in order to become the number one chip manufacturer again. I currently have this stock as a buy, but one thing to keep in mind, they were recently dropped by Apple to be the chip producer for the iPhones, so if they can win back Apple's business, which has been one of their priorities by CEO Pat Gelsinger, which I love, I think that would be huge for them if they can win back Apple's business. Currently, I have Intel rated as a B. I think it's a good holding to have, and I think it's an attractive entry point right now. But again, there is a bit of risk there because of how much they're investing. But I'm confident that with under Pat Gelsinger's leadership, they'll get through it. The next stock is the most controversial stock in the dividend investing community, which is, of course, AT&T. I realize that most of you would probably come from an AT&T video, so you guys would know that they cut their dividend, but even with that dividend cut, they have such an attractive yield still at 5.5%. They have a payout ratio of 55%, which I think definitely is much more safe and sustainable. A 5-year growth rate of a humongous 1%, which I mean, their dividend was humongous, so they didn't need to grow it crazily. They don't perform share buybacks, which could be not attractive to some investors. Their PE right now is a whole 7.9, so it's definitely trading at a discount as it has been for a while. They have increased free cash flow, which is amazing to see. I gave AT&T, a B, mainly because, there has been some rocky management decisions, but I think for the future right now, without Warner Brothers Discovery, which has not been performing greatly, I think they're a much more focused telecommunications company and should be able to drive in large free cash flow for that big dividend payment. I currently have AT&T as a buy, but I think that it will be trading at a discount for much longer than some of the stocks like, Apple, Microsoft, Visa, etc. I recently, capital gains wise, have become flat with my AT&T investment. So for about the 3 years that I've been invested now, I've made good returns off my dividends. The next stock on the list is Coca-Cola Company, stock ticker KO. They have a 2.93% dividend yield, a bit of a high payout ratio at 70.25%, a 5-year CAGR of 3.66%. So again, not huge growth, but what do you expect? Such a huge company. They have flat gradual share buyback, so it's gradually over time going down, which is good to see because your value as a shareholder will increase over time. Currently, they're trading at a 24.29 PE ratio, which I think is really high, and I don't think it's fair for, such a big company with not a lot of growth potential such as Coke. Definitely not trying to diss on Coke here, but I don't think it's fair that it's trading at those high PE ratios where you can get much more growth potential with the same PE ratio with, Apple, who's trading less than that, which is absurd. Coca-Cola is almost a dividend king and has been increasing their dividend for 59 years. They have increased cash flow, and I gave Coke an A. I think that it's just a slow and steady, stock, which, again, slow and steady wins the race. I'm not too sure if I want to be reinvesting my dividend into Coke right now, but eventually later on, I think it's just going to be a cash-generating machine for my portfolio. The next stock on this list is PepsiCo, stock ticker PEP. They have similar financials to Coke. They have a smaller dividend yield at 2.78%. They have a 68% payout ratio, a better CAGR than them for over the 5 years, which is 7.39%. Nice to see. Gradual share buybacks. They're trading again at a PE ratio of 24.91, which, kind of amazes me that these are trading at the same values as, your Apples and Microsofts and stuff. But, I think investors these days, they're going towards these stocks because they understand that they're slow and steady and they don't want to lose all their money in some of these tech stocks that are going down. 49 years of dividend growth, great increased cash flow, and I gave this one an A along with Coke. As mentioned earlier, I think these both are tremendous companies to own in any long-term portfolio, but you can't be buying them at these type of prices, so that's why I'll be waiting to buy, and I have it as a hold right now. Next, we have the stock that's been falling like crazy recently, and Target. Target has a dividend yield of 2.34%, a nice payout ratio of 28.05%, a 5-year CAGR of 8.45%. They do perform share buybacks. They're currently trading at a PE of 14.52, which I think is, pretty low for a good company like Target. 54 years of dividend growth. They have increased free cash flow, which is amazing to see. I gave this stock an A simply because they are getting hurt right now by, recession fears, inflation, and higher costs. But over the long term, I think that it's a tremendous stock to own, and I think that this is a good buying opportunity. Right now, I think Target is a good buy, and I'm a big fan of their CEO, Brian Cornell. If you guys haven't already watched that Target video I made last week, I'd highly recommend you go check it out. The next stock on this list is going to be VF Corporation, stock ticker VFC. VFC I bought a long time back and haven't really looked at it since, but I know that it's been going down a lot. Right now, VF Corp has a payout ratio of 63%, a dividend yield of 4.3%, a 5-year CAGR of 5.89%. They do perform share buybacks. They're currently trading at a PE ratio of 13.94. They have 48 years of consecutive dividend increases. They do have free cash flow increased over the last 10 years. I currently gave VF Corp a B. I think that their brands are all good, but not great, compared to Nike. They've been experiencing a lot of issues recently, but I think right now it could be a decent time to buy back into VFC, but I'll have to do more research on this stock. I currently have it at a buy at a nice PE ratio of like 13, 14. But again, I'll have to do more research if I look to add. The next stock that I own is Nike. Nike has a whopping 1.12% dividend yield, a 30% payout ratio, so it's very sustainable, a very nice 5-year CAGR, 11.27%. They do perform share buybacks. They do have a pretty small dividend, but again, that 5-year CAGR is what you're investing for. But again, as I mentioned earlier with some of these companies, Nike's probably one of the strongest brands in the world, but with that, you're paying a premium. They're currently trading at a P ratio of 29.02. 20 years of dividend growth, free cash flow has been increasing. Very great company fundamentally. I gave it an A, but I think it's a hold right now with that huge PE ratio of 29, and I think it's just kind of absurd that it's trading at that. The next stock on this list has recently emerged as one of my favorites, which is Kroger. Kroger currently has a 1.67% dividend yield, a 22.01% payout ratio, 11.84% CAGR, which is very nice to see as well. They perform share buybacks. Fundamentally, from a balance sheet standpoint, Kroger is a tremendous company to own. They're currently trading at a PE ratio of 13.24, which I think is definitely fair for them. So I'll be looking to buy more Kroger sometime this summer for sure. Now onto my utility stocks. We got Southern Company coming up here. They have a nice dividend yield of 3.59%, a 3% 5-year CAGR, and a 77% payout ratio. A bit high there in the payout ratio, but at the same time, utility companies are different financially speaking. Right now, I give Southern Company a B+, but I think it will be interesting to see how their nuclear energy goes, which they've been investing in recently. The next stock is a very interesting one along with the dividend growth investing community, which is NextEra Energy. NEE has a dividend yield of 2.28% and a crazy 12% CAGR for a utility company. They have a 60% payout ratio, which is sustainable for a utility company, but they're making a lot of investments in renewable energy, which is why I think it's so interesting and intriguing for me to invest personally, because I think renewable energy, it's going to be a big thing coming up. We're studying climate change right now in school, and the effects of it are really detrimental. So I think it's going to be a big part of the world for the next, decade, century. So I definitely want to be a part of that with NEE, which is by far the biggest utility company investing in these, changes. Right now, NEE doesn't have increased free cash flow, which may be a little bit of a concern for some investors, but they are currently investing that money, as I mentioned earlier, back into new renewable energy sources. So in the long run, it will all pay out. And I gave it a B-, and I gave Southern Company a B+. I think, slow and steady wins the race. You're not going to see crazy growth from them. But again, I think these companies, they aren't getting beat up as much. So I have both of these stocks as a hold. I think there are better opportunities right now. The next stock has quickly emerged as one of my favorites, and it's been on a dip recently, which is the Walt Disney Company. Disney suspended their dividend and their stock buyback program because of C-19 and the lost revenue that they'd be losing from their parks. But don't worry, Disney said long term they would be reinstating these programs in the recently quarter report a couple, quarters ago. As I said earlier, I think Disney, is on a dip right now. It's currently trading at a PE ratio of 24.81, which for Disney's growth potential, I think that's a pretty fair deal, and it's undervalued right now. Disney has one of the strongest brands in the world and such a wide economic moat, which is why it's so intriguing for me to invest. They've also been doing really good with their streaming, and with the reopening of China, I hope that they can be reinstating that dividend maybe in the Q4 this year. The next stock that I own in my portfolio is the Colgate Palmolive Company. Colgate currently has a dividend yield of 2.41%, a 57.32% payout ratio, and a 5-year CAGR of 3%. They do perform share buybacks. They have good free cash flow. I gave it a B+. It's slow and steady stock wins the race. I currently have it as a hold because of its PE ratio, which is 25.45. Again, guys, investors are heading towards consumer defensive stocks right now, so definitely I'm staying away from them right now. The next stock on my portfolio is going to be Kimberly-Clark. KMB has a 3.51% dividend yield, a pretty high payout ratio at 80% right now. Hopefully they can work to get that done. 5-year CAGR of 4.19%. They do perform share buybacks. They currently, again, they're trading at a PE ratio of 22.64, 49 years of dividend growth. They have flat free cash flow right now. I gave it a B just because, they're flat free cash flow. They're pretty high payout ratio, but they do have really good brand power they're being killed right now by inflation and pulp inflation. I currently have it as a hold, but I think it should be in your long-term portfolio if you're looking for some good diversification and, of course, dividend income. The next stock on my list is going to be Waste Management, at a 1.67% dividend yield, a 46.75 payout ratio, and a really nice CAGR of 7.49%. They perform share buybacks. They do have good free cash flow increased over the last 10 years. Currently, Waste Management is trading at a pretty high PE ratio of 28. That is pretty high for Waste Management, if I'm being honest. So I definitely have this as a hold right now in my portfolio. But I never realized how high of a quality company they are on the balance sheet. Really good free cash flow, good dividend increases. So I might be looking at dollar cost average and buy on dips, as I've realized that I might want to have this as a core position in my portfolio over the long term. The next stock on my list is a pretty undervalued stock in my opinion, at Walgreens Boots Alliance. They currently have a dividend yield of 4.5%, a pretty low payout ratio of 32.65%, a 5-year CAGR of 5%. They have, gradual flat shares decreasing, which is good to see. They're currently trading at a PE ratio of 8.44. Pretty undervalued right now in this market. I have it as a buy because of that really nice PE ratio. They're good financially. They are not doing too great free cash flow wise. They're pretty flat. But their new CEO, Rosalind Brewer, who came from Starbucks, she looks to get that up in the near future. I currently have it as a buy, but I think it will be at these prices for a while, so I might want to look elsewhere. The next stock on this list is Altria Holdings. A lot of people stay away from Altria because it has risky headwinds with, their business, as they are a sin stock. They're heavily involved in the tobacco and marijuana industries, which, are really heavily governed. But they're trading at a really nice PE ratio right now of 11.1. They have a really nice, juicy dividend, if I'm being honest. And I think that dividend, payout ratio of 76%, I think it can be justified, as they really aren't making any crazy investments right now with the industry that they're in. The next stock that I own is Corning, stock ticker GLW. They have a dividend yield of 3.2%, payout ratio of 45%, and a 12% CAGR over 5 years, which is really nice to see. They have good share buybacks. They make glass and special glass for technology companies, including Apple and their products. So that's, one of the really big selling points for them. The next stock is one that I've owned for a while, which is Hasbro. Hasbro makes toys. They're currently trading at a PE ratio of 15.94. So I have it as a buy. I think it's a decent company to hold in a long-term portfolio. They're pretty safe. Good dividend growth. Slow and steady, as I mentioned earlier, slow and steady wins the race, and I think they're definitely a cash-generating machine with all the toys and licenses that they have to toys. Now, onto Hershey. Hershey's one of the first stocks that I've bought, and I've just let my dividends reinvest and work themselves with that. They are currently trading kind of at a premium. They are a consumer defensive stock at a 26 PE ratio. They have a nice CAGR of 7.85%. Right now, I have Hershey as a hold. There's not crazy growth there, and I don't think it should be trading at a 26 PE ratio. But fundamentally, they are a really strong company. The next stock on this list is going to be UPS, the shipping company, which I've realized is a really strong company. They have a 3.5% dividend yield, a 37% payout ratio, a really nice CAGR of 9.55%. They have gradual share buybacks, they have increased free cash flow, and they are currently trading at a PE ratio of 14. So I think, UPS, it's a good value right now. I would buy it if I had more money. on to my REITs, and I didn't include the information here because REITs are different, valuation-wise. But we have First Realty Income, which is a dividend investors, match made in heaven. Really good company. They own a lot of recession-proof stocks, which I think definitely showed during the C-19 pandemic. Then we have Stag. They own industrial REITs, which are like, storage buildings. They haven't been performing too well recently, but I might be looking to buy as they're on a dip. Next, we have Vici, which has been performing actually nicely recently, and I think we need more Vici representation in the YouTube investing community. They own, a lot of valuable land. They do have a really good wide economic moat in the Vegas Strip. They own a good portion of the Vegas Strip, actually, which is, an area where I want to be in my future. And then lastly, we have a stock that I regret a lot, which is Tattooed Chef. I blindly took advice here from a YouTuber. I think we all know who he is, but I'm just going to hold this stock for a long time. I have 3 shares. I bought it $16, $22, and $24, which I don't want to talk much more about. But, the products are decent. I enjoyed the mac and cheese bowl, but I definitely do regret buying the stock. But hopefully, I'm looking to hold it for a long time, so hopefully my investment will make itself back. But I really didn't understand valuations when I bought it, and I bought it blindly. And there you go, guys. Those are all 33 positions in my stock portfolio. I'm sorry if I sound a little tired, but it gets a little repetitive doing this. But you know me, I'll do anything for you guys. I really thank you if you made it this far. I don't believe that you have, but thank you guys so much that, you watched the video. As I mentioned earlier, make sure to subscribe, turn on post notifications. What stocks that you see that in my portfolio that you guys like, let me know in the comments section below. And of course, do dividend stocks, not drugs. Have a good one.